Right. Well, welcome everybody to the late summer, August 18th edition of Bull Sessions. This is Mark Robertson. I am joined here by Ken Kavula and special guest Hugh McManus, who just came in. And again, welcome to everybody. I hope your weather is 1/10 as good as what it is up here in northern Michigan. I do have a warning. I am at a family retreat, and there happens to be a family tennis tournament going on within about 30 feet of me. So you could hear cheering, you could hear um, consternation expressed on the tennis court. Well, hopefully it won't get too bad because there are some small children around, but pretty pretty interesting, and hope you all can have a wonderful day like today. Any thoughts on the general conditions out there? I haven't been paying any attention to the stock market. How's the stock market doing, Ken?
It's pretty flat today. The S&P did hit a historic all-time high and then backed off of it a little bit. I haven't looked recently, so it might be back on. We're getting some another stock to take a look at some point, Mark. MESO, M-E-S-O, deals with medicinal signaling cells for
Right,
COVID-19.
right.
That's from Nick. Okay, so.
Yep,
Uh,
we'll be taking a closer look at that one for sure. That's one that I was aware of.
okay.
Well, good
All
stuff.
right.
It could be an abbreviated session today. Who knows? But we do have Tesla on the table, and Tesla is kind of our poster child, the latest poster child, I should say, for emerging young company that can be pretty tough on a stock selection guide. And we'll check in with Kramer and the COVID-19 index also. But let's go ahead and get underway. All right, standard disclaimer. This is all about education and demonstration of a philosophy. No investment recommendation whatsoever is intended. This is all about illustration and, as we said, demonstration. Please do your own homework. If you'd like to have a reminder to our monthly roundtable webcast, it's always the last Thursday of every month, 8:30 Eastern Time. You can send an email to nkavula1@comcast.net. If you have any follow-up questions or things you'd like to kick around or would like copies of the slides, although as a reminder, we've got a lot of people here, but most of you are Manifest Investing subscribers. So the slides and the link to the audio recording is available on the Manifest Investing forum. But please mark R at manifestinvesting.com if something is on your mind. All right. Little extra disclaimer today because we're going to go into an area that is not necessarily for beginners. There's a lot of experienced investors here in the room, but just that reminder that this could be a topic that's not necessarily for a beginner, other than to take notes, be that sponge. When you hear things that you're unfamiliar with, just go on a never-ending quest to discover the answers that you need, take the mystery out of it. But we're going to be talking about what George Nicholson referred to as general market securities. Some would call them non-core. And again, that can be speculative, that can be turnaround, early stage investing, which is what we're talking about here today, but just basically a number of different things that can be quite challenging to a conventional or traditional analysis. We do believe that an experienced investor should experience balanced investing. He
My,
was one.
my favorite tag that Nicholson put on these, Mark, was non-traditional. I just love those words.
Yeah, he definitely had that right. And there are some fairly non-traditional examples, and Hugh is a pretty good source of non-traditional ideas for the roundtable every month. So it's kind of fascinating to watch that sort of thing because all of us know with a wink and a nod to Hugh that he's got this stable of core investments also that he doesn't talk about quite as often. Would you agree with that, Hugh?
I do, yeah. I prefer obviously the core investors because they're predictable over time. But the good thing about the non-core is they can generate money for me to invest in the core investments.
Nice.
And for every successful company, before it started to have a nice, well-behaved stock selection guide, it was a mess. And so I like to look at the upstream parallel companies to try to discern which one of them has a bright and glorious future? What did Microsoft or Amazon or Tesla look like? You know?
That's a quote we need to take down, Mark. Direct and glorious future. Okay,
Right.
I love it, Hugh.
Right up there. If you blend in a little loathing, you can really go somewhere. Funny, again, one of the reasons we bring it up is because Hugh does entertain us with these every once in a while, and we also like to point to David Gardner of the Motley Fool. He's had a tremendous career of picking stocks for his stock advisory newsletters, and one of them is referred to as a Rule Breaker newsletter. And if you really look at his track record over, he's got some real duds along the way, but the successful ones way more than make up for the duds. So we would encourage you to dig a little bit deeper, understand that, and pursue that sort of thing. Okay, a reminder.
Mark, I have a notoriously bad reputation for walking away from my non-traditional investments. And I'm going to brag for just 8 seconds about one that I made in the last 5 months that I had the courage to walk away from at some point. Basically, I was prodded away from it by my wife, but I put money into Inovio, which is developing a vaccine.
Sure.
And I put money into it in the low teens. I was prodded to leave it in the low 30s, and it's back to the mid-teens right now. So for a change, I didn't follow it up and follow it right back down again. So I'm very pleased with myself right now, and I'm giving Natalie 85 or 90% of all the credit for prodding me out of that investment.
Oh, Ken, I'm not sure we even know you anymore. We don't know who you are. Take 2 aspirin. All right. So just as a reminder, this is kind of an experiment, but we're kind of falling in love with it for no other reason that it really is nudging and pushing us into areas that we should be exploring. It's going to help the traditional core stuff. I just think that there's a lot to be gained from this. We have a queue of topics we want to cover. Today we're going to hit those ones up at the top. Ken's going to introduce a little bit about traditional retail stocks and how they might be getting punished right now, but let's go ahead and keep pressing on. All right, here's the slide for the day. I told you I was at a family tennis tournament. This is actually a couple years old, so that's our other grandson sitting there waiting to play, but I think this one pretty much captures it all. And that is a direct quote. And, I got to say, I was completely stunned by the answer and his outlook. And to finish off the slides, there you go. If I remembered that, I had forgotten it, and my 3-year-old grandson reminded me. So the moral of the story is never get behind a lion. So the Lions kind of overpowered the Bulls here today. All right. We have a lot of people joining us for multiple weeks, so you've heard this topic. But again, I just wanted to reinforce before we launch into Amazon this notion of looking at another metric, this projected return on value, or PROV.
$15
and
for...
you can see, hold on for just a second. It's a high traffic zone. Apologize for that. Anyhow, you can read the slide as well as I can, the talking points. And again, it's just looking at this metric of thinking through ownership of the business, thinking about the projected pre-tax income. In this case, we're going to talk cash flow here today, but divided by the capital structure of the company. Again, the market price that you pay for, the investment you make in combination with their total liabilities, and then a correction for the amount of cash in their checkbook. Now we have a phone ringing somewhere. Hold on for a second. It's not my phone, people.
It's a shout out for some Apple stock there.
Is it split yet? I know Lynn Douglas is doing the Apple Watch. Anyhow, what we're looking at is this metric, and in this case, the possibility that it could provide some intriguing capability of taking care of those companies that are very early in their life cycle that basically, again, the way I would probably summarize this is there have been times when Hugh McManus will present a stock at the national convention and we put the visual analysis up on the wall and there's no blue line and no earnings. And the audience will laugh. And that's when you know you're talking about a non-core stock. I mean, there is no up, straight, and parallel, nothing like that. But we really think that using this type of a metric, this type of analysis can lead us to opportunities earlier in the company life cycle, and they can be, although they're fraught with risk, slightly or potentially rewarding. So let's go ahead and talk about it. Again, here's the context that we have provided on this metric. As of right now, this is the population of companies in the value line industrials based on their projected return on value. So you can see there's the bell curve right in the middle. Anything in that 6 to 8% range is kind of your average stock right now. And then the ones that we would find attractive would be in that low double-digit range. And obviously there are a few that are off the scale to the right. So again, it gives us context. Again, that number resembles a projected return in Section 5 of the stock selection guide. So far, it looks like it's a little bit lower, but it certainly resembles it, in my opinion. And we gathered here last week, and we talked about it a couple weeks ago, this notion of Tesla and what kind of company is Tesla. It's not just an automobile company, batteries, roofs, electric roofs, panels and shingles and all that kind of stuff, along with other things that they're into. They really are becoming an energy company, a very innovative energy company. So not just an automotive company. I think that's a mistake that many of us make. If Hugh wants to bare his soul a little bit, I'll set him up. I mean, we have been comparing notes on how in the world did we miss this company? Going back over the last even couple of years, there have been opportunities. And my confession is I just kept thinking it's just another car company, and what can we really expect from another car company? It's such a challenging landscape, but things are definitely changing. How do you feel about it, Hugh?
No question. I'm just kicking myself because it's not like Tesla wasn't in the news. Elon Musk is a really controversial character. He believes in confronting anything that's in his way, and that includes the SEC, which often seems to be a suicide mission. But he suggested many things to the agency, which your jaw drops when you hear him.
Yep.
And it's not only Tesla, but it's all the other components. The Boring Company, which is there to build tunnels, and they have accelerated that technology mightily over the last 5 to 10 years. And you look at SpaceX, of course, which is not a separate, distinct entity, but maybe there are synergies, at least intellectual synergies between or among all of the component companies in his portfolio. But it's astounding what he's doing with everything that he touches. And as I said, the evidence was there forever, and I was aware of Tesla, really hadn't paid much attention to its financial side, just more the glamour side of anything. And now when I look at the company, and as I've gone into the solar energy side of things, looked at the car, looked at the chip that it has designed to do autonomous driving, it's stunning where they are, absolutely stunning.
Yeah, and I have to say, I don't want to canonize the guy, but I really wonder if he's not some kind of time traveler in some cases. Pretty wild.
Well, that explains a lot, if he is.
All right, so let's go ahead and take a look at the company. Go ahead, Ken.
We had a discussion, Mark. We had a discussion in the Wolves Investment Club. That's my primary club, my private club, and came to the conclusion that maybe the size of Musk's personality kind of overshadowed the fact that this was a serious endeavor. It seemed to be a lot of times that he was almost like a carnival barker, talking about things and making promises and telling you what was going to happen. And now we're starting to see these promises come true, and some of the things he predicted are actually in progress now, and he's turning out not to be as silly as maybe he first came across. We think that maybe a lot of us just had a distaste because he was so out there and so outspoken and so outlandish a lot of times in what he said.
Yeah, I think that's part of the distraction. I mean, and we'll talk about in a minute how you get around that distraction a bit. But I mean, at this point in the, after studying so many companies and success over the years, all three of us ought to be fairly familiar that every once in a while a very innovative person comes along that most people see as a lunatic, and it's in some cases it's just part of the package. And that's one of my excuses. I agree with Ken. I saw some of the stuff he's doing and say, "Wow, unbelievable." So in those situations, we know better. We know we should, take a step back from the forest, take a look at the big situation. What you're looking at is a visual analysis on Tesla with the components that are on a traditional stock selection guide, with one major difference. We have substituted cash flow down at the bottom here. So this is cash flow. This is sales or revenues up at the top of the chart. And we can see they have very nicely settled into a 17 to 20% growth trajectory up at the top of the chart. You can see that the stock price has been fairly stagnant for a while. There was pretty decent opportunity at the end of that flat spot, not unlike something we would have seen with a 1970s Home Depot. And several times over the last few decades with a company like Home Depot or Nike or any one of those companies like that, they have those flat spots. But what we have done, as most everybody on the call knows, they just started making positive earnings over the course of the last year. They have 4 straight quarters of positive earnings. So we stepped back to substituting cash flow for earnings, and you could say they began noticing positive cash flow back in 2013, 2016, and it was kind of a bubbly start there. And then come 2018, you can see that the cash flow trajectory started heading north on our chart. So again, a stock selection guide substituting cash flow for earnings, as we've done many times in the past, including Amazon. We'll probably take a look at that next week, but Ford and deep cyclicals, that sort of thing. Nicholson guided us and encouraged us to use cash flow when earnings were rough. And again, keep in mind that Nicholson was operating back in a period where we had recessions every 4 or 5 years. And there were a number of pretty solid companies that saw their earnings go negative a couple times within every 10-year period. So the antidote to that, because what negative earnings do to a logarithmic chart, is to switch to cash flow. And in this situation, you end up with a fairly compelling situation. Now, notice what I have done. I'm basically disregarding some of the very early sales growth there just to get our arms around this trajectory over the last 5 years. By the way, 1 year ago, here in August, the stock price was about $200 for Tesla, and it's now approaching $2,000. So, I mean, that's just staggering. But we had that moment in time that everybody said you're crazy to be investing in Tesla, but maybe those people are crazy all the way to the bank. So again, some fairly interesting underlying fundamentals here, especially when you look at these type of characteristics. So we will be looking at Amazon under this microscope to see what we could have learned from Amazon over the last 5 or 10 year ago period. I do want to take us back to Neogen, companies like Neogen, say 20 years ago. And, look and see as these companies are taking shape, beginning to generate positive first cash flow. It comes before the earnings, and then the earnings. Any comments or questions from either you or Hugh, Ken?
Well, we have a couple people wanting to know how you're out in 2021, 2022. Those are estimates out that far, obviously.
Mm-hmm.
So, and that's pretty standard for what Manifest does when it puts an SSG together.
Yeah, those are analyst consensus estimates for sure. Okay, we'll just keep pressing on. I have to wonder why I've never done this before. I'm a numbers guy. I like charts, but I also like numbers. What I did is I went back and took a look at the Value Line quarterly reports for the last 10 quarters. That you can get the last 5 quarters pretty easily, but you can get 10 quarters if you dig back a little bit deeper into the Value Line archives. And again, we're just looking at 10 snapshots over the last 2.5 years, and you can kind of see how this stuff is all taking shape. Notice how in the fourth line down, how the sales growth forecast has matured from 20 to 30. It's kind of hanging right in there into that upper teens area now. Notice that the projected cash flow margin, which is the same thing as net margin, only using cash flow instead. It's the cash flow divided by the revenues. Notice that Value Line has them in the 10% range, and that's actually a fairly steady number over the 2.5 years that we're looking at here. You've got the shares outstanding. You see all the other things. Look at the price to cash flow ratio. It's something we're not that familiar with. They're getting a little bit more feverish about it, but our attention is drawn to the middle of the page where that projected annual return actually did top out in that 15 to 20% range about a year ago. You can see that the capital structure has been evolving over time. Here's that metric that we've been talking about, projected return on value. It also peaked out, actually did reach double digits a little over a year ago. And now with the recent run up in price, it's actually down in low single digits and is probably overpriced. But I would argue, in line with some of the stuff that we've been saying, is it's probably not as overpriced as most of the experts think it is. It's just something you're going to have to scratch your heads over. You can see the progression of the long-term debt and their interest payments, the effective interest rate that they're paying. Notice that the relative strength index that we talk about every once in a while at the roundtable, actually reaching into the 20s back a little over a year ago. Again, that should have been a nudge to me if I hadn't been distracted by the lunacy. And then last but not least, again, a traditional stock selection guide is nearly impossible, but using the type of analysis done by Value Line, we talk about this all the time. Value Line they struggle with an early life stage company. And notice how those numbers are pretty unattractive over that entire time frame. They're even not that attractive back when it appeared to be potentially very attractive about a year ago. Any thoughts or observations on this, Ken?
I think this is a wonderful chart to take a lot of the emotion out of what's going on and to show you in actual numerical progression exactly what's happening quarter to quarter. It's too bad that this kind of data is not available for a couple thousand companies that we could take a look at as we're moving through. But this is a really nice picture, Mark. Especially if you're a numbers guy, and I know you are, and I know I am. So it really speaks to me in a lot of different ways.
Yeah, so we will construct these on a few companies as we begin to warm up. I really like the notion of this progression and watching the ebb and flow here a little bit, but also the evolution of the company, from a debt standpoint over time also. I think there are many companies out there now that are taking on a lot of low interest debt that this would be a very interesting analysis to perform and at least stay very abreast of. What I also find, and I'm just going to say this is cool and it warms my heart. This is the Chronicle at Manifest Investing, which is the same thing over a little bit longer time frame, but it's monthly, not quarterly. So you have monthly stock prices with the green bars. You've got the quality, which has been ever increasing, which is natural for a early stage company as they kind of establish a track record. That quality, as long as they execute well, will continue to increase. But most importantly, in this case, the projected annual return about a year ago reached that peak that you see on the right-hand side. So that lines up with what you saw with the numbers on the previous page. And I guess my instinct on this will be to try to promise myself that when I see that type of a condition, that peak on the right-hand side, which always attracts our attention, is to be less dismissive and maybe dig in a little bit harder. On the next company where we see this, maybe it'll be Meso that was described before we started the session. That sort of thing. Be less dismissive, be open-minded, be ready to be wrong, but again, I just think it's a room for an investor to grow and prosper because I have friends who bought Tesla a little over a year ago, and I tried to get them to pay for this vacation up north here. They wouldn't do it. Um, again, these can be very rewarding situations when you come across them. Any
I
thoughts?
also think, Mark, yeah, I also think that that quality line, that blue line that essentially since the start of the graph is trending upward, even though there's a couple of downward places, but for the most part, the trend is upward. I think that's a real positive thing, especially if you kind of compare where the quality was when that peak par was hit. It's the kind of thing that you want to see happening. You want to see quality moving in the same direction, upward, and you'd like to see a par that's traditionally high for the stock. Doesn't necessarily have to be at the all-time high, but I'd like it to be at one of the top, maybe 1 or 2 or 3 points high in the last 3 or 4 years. So this is a chronicle that also, and you're right, if you would have disregarded a little bit of the chatter about the company, you might have said to yourself, it's worth a couple hundred shares,
Yeah, absolutely.
especially at $200,
Mhm. So again, thinking in terms of what we're talking about here, we're talking about thinking more like Hugh McManus or David Gardner and being open to at least a fair day in court for an early stage company, especially when they reach that point, like we saw here in the 2015, 2017 timeframe, where they begin generating positive cash flow. And again, it's one of those situations where if you believe that the earnings are probably going to follow, or they have a decent probability of following, that trajectory, it probably merits some pretty good attention. So we'll come back and study this. I would just encourage the people in the audience, again, the slides will be available in the Manifest Forum. Take a look at this chart and just kind of scratch your head and think about, the various components and what we're talking about, and how this projected return on value, which I will argue is probably going to be a real nice, fairly stable gut check or sanity check on many of the companies that we study. So,
Mark, Herb Lemkel is making the point that isn't that chart that you just were showing, isn't that basically telling you to sell? And I think this is much like the Apple stuff we were looking at before. I think it might prod you to think about selling all or some of it, but I don't think it's necessarily shouting sell at you, depending on what you're looking at and depending on which of the metrics you're believing. I understand, Herb, how you can come to that conclusion, but I'm not sure that I would sell the entire lot, whatever it is. Again, I'm looking at selling when I move down towards my par and then move towards money market, and I'm certainly below money market and my par. But when you're selling on valuation, I've learned to be a little bit less trigger happy than I was perhaps 3 or 4 years ago, as far as being that mechanical about the whole thing. I know Mark shows a portfolio of that's mechanically managed, the Tin Cup portfolio, where sells are automatic, but I'm finding in my own personal portfolios that I want a little bit of control over sells, and I want to be able to think through them a little bit more carefully than just pulling the trigger when a certain barrier is hit.
it's a great point. It's a fantastic question. The thing that Nicholson would point us to is this number up here. Anytime you're dealing with a company with double-digit or above growth, he counseled be careful about selling it. And I would dovetail this with the discussion we had 3 or 4 weeks ago on Apple, / did we make a mistake? I think the mistake was not embracing the momentum approach of a trailing stop limit order. And I think if I actually had a few hundred shares of Tesla, I probably would take a partial partial position and put a trailing stop limit order on it and be okay if I got sold out of it, especially as this split run up happens. But yeah, Herb's point is well taken. And we will spend probably an entire session or two on Nicholson's words of encouragement about don't be too frenetic to sell a high quality double-digit growth company. So we'll come back and visit that subject in greater detail. And again, I think it dovetails with the pain and agony we have over straight up selling Apple at 300 and watching it go to 500. Yeah, I'm still noticing and feeling bitter. I mean, I did forget to sell some in a personal portfolio, so that makes me feel somewhat okay. All right. Quick reminder, I just wanted to remind everybody and make one error correction. We talked about the COVID-19 Kramer Index a few weeks ago. The book that we actually did the book report online was his Get Rich Carefully book a little while back. And as we've noticed, he is an investment clubber. He's definitely a closet investment club member. He invests like we do. Quick update on the companies that are at the top of the performance list. This is a pretty fantastic list that Ken brought us that is 100 companies, and there's like 20 stocks right there that have more than doubled, and in fact, some of them have quadrupled since early this year. This is year-to-date type statistics, and it's really a fascinating list. I think only 4 companies have lost ground out of the 100, which is just mind-boggling. And one last note, and we'll turn it over to Ken. We did add the 12 or 15 companies that we didn't previously cover. They are in this dashboard at Manifest Investing. You can see the link up at the top to the public dashboard, COVID-19. And Peloton and Zscaler have been added to the Manifest Investing database. We will be auditing those, but again, the companies that were not covered previously are now there, so all 100 companies are there. These things have been on a screaming hot run, so there's not a whole lot of hugely attractive companies, but you can see that some of those have floated up to the top of the list. And Ken, you continue to be doing some interesting shopping in this area, right?
Yeah, we're actually running a number of these through the Wolves Club right now, trying to figure out how to look at some of these early stage companies with no earnings. And you've given us some food for thought by using price to cash flow and everything. You've always talked about it, but here's a very practical way to display that kind of information. So we'll be seeing. We do own a couple of these on the list, and that makes me feel real good when I can look at a list like this and say, you know, I own a half dozen of these already. So.
Yep. And we will be going in deeper into the PE discussions and the price to cash flow, so we'll keep that in mind. Well, in the spirit of shopping, I thought we would leave with a topic that Ken was kicking around last night about maybe some of these retailers have really been beaten up and bloodied by the Wall Street analysts. So Ken,
I was on the phone with Mark this morning and talking about a discussion we had in our Mid-Michigan Model Club meeting on Monday, just last night, about some of the retailers and specifically about O'Reilly Automotive. We looked at our SSG on O'Reilly and it was signaling a buy, and we went to Manifest and Manifest was signaling at best a hold and maybe even a sell on O'Reilly. And we were asking ourselves where the discrepancies came, and after a fair amount of discussion, I think one of the conclusions we came to was that perhaps the analyst community, and remember the Manifest numbers are based on the analyst community, we felt that perhaps the analyst community bunched all of the retailers together into one group, said that they were closed down and were not going to perform, and gave them fairly low marks for sales growth and earnings growth. Well, you know, that didn't happen with the auto repair places, with O'Reilly. And if you look at the data, you'll see that O'Reilly's price took a real punishing drop back in the time when the economy shut down back in early March up to March 23rd, but also has done a very quick turnaround. You know, the talking heads like to talk about V-shaped. So they did a nice V-shaped turnaround. I don't know where Mark's headed with the display right now.
I was gonna go get you some current information on O'Reilly, but I'll just let that go for another day.
Okay, all right. But so we're sticking with O'Reilly, and we actually bought a little bit of it last night, and we're using our own SSG, which is a little bit more optimistic. Today I sat and watched CNBC for about a half an hour early in the morning when some of the big retailers were reporting. I wanted to see how they actually did, and I saw reports from Advanced, is it Advanced Automotive? That's not the right name.
Advanced Auto Parts.
Advanced Auto Parts, right. And Home Depot and Walmart reported this morning, and they all beat quite handily the analysts' estimates for growth in revenue and in earnings, beat by a factor of 2 or 3, or in some cases 4 times, so that they were really off when it came to predicting what was going to happen. I'm not so sure that the same thing might not be true about some of these retailers on here. I guess what I'm saying is it's like a pendulum, and maybe the pendulum swung too far to the negative direction for some of these retailers that really didn't close down, that business kept operating. Nike, for example, didn't close everything down. They closed a lot of its stores, but remember, they're a manufacturer as well as somebody that sells. So, you know, maybe that sales growth rate wasn't as low as it's being demonstrated right there. I especially look at O'Reilly's growth rate at 6.8, and every single analyst that I'm looking at today, last night when we were doing it, was calling for sales in the 9, 10, 11, 12, 13, 14% range with earnings growth to match. So I'm wondering if there hasn't been a rebound, and we should be looking at a lot of these retailers that escaped the closure of most of their outlets, and asking ourselves whether or not there's still some value there to be had as you take a look at them. It's just, that's the only point that I was making. I don't think there's anything wrong in the arithmetic going on at Manifest. I think the numbers have all been collected properly. I think everything's being calculated properly. But I think there's a number on this list that maybe are being penalized for what happened to a fewer amount of retailers. I understand why you penalize TJX and Ross stores. They closed down almost every single physical location they had and operated only through their electronic channels. But I'm not sure that you penalize some of the other ones. I'm not sure that Dollar General's sales were only growing at 8%. That's not what their last couple of quarters have demonstrated, and that's not what I'm predicting the growth is going to be for a store like Dollar General. So it's something that we're talking about, and I thought would be interesting.
Yeah, and in fact, I'll second that. I will point out that Wall Street rhinos, the institutional analysts, are not immune from recency bias, and maybe a little bit stubborn about recognizing when you're really in an outlier condition. And I'll hand out some homework. In fact, Hugh's going to like this one. If you go to the Manifest Forum into the stocks discussion area and you look at United Airlines, you'll see the predecessor to the Tesla thing that we just presented here. And I think the only way to look at United Airlines is much like Hugh does. He basically looks over and beyond the next year or two and focuses in on the long-term perspective that, where would you really expect United Airlines to be 3 to 5 years out? Is that a fair assessment, Hugh?
Yeah, exactly.
Yeah, because you think that United Airlines, and in fact, I'll go so far as to say I think United Airlines might be a little bit more vulnerable than his Bank of America 10 years ago. But
Yeah, I would agree with that. Yeah.
yeah, it's a situation where that company's has a low probability of disappearing from the planet, in my opinion.
Yeah, all three airlines are in a similar boat to some extent, the majors and maybe Southwest as well. But Southwest should recover fastest because it has a disproportionate amount of domestic travel, and I would imagine domestic travel will recover a lot faster than international.
Yeah.
United has the most exposure of all the airlines to overseas travel.
Yes. So again, if you believe that it's going to disappear, you probably shouldn't be owning it in the first place.
Exactly. Yeah.
But if you believe that it can persist and prevail in the long term, so again, your homework is go to the United Airlines entry in the stocks forum, and you can see that I very blatantly left out 2020, 2021, 2022, which again, that recency bias, I think that is really gravitating the analyst attention away from the long-term perspective, like Ken was talking about. So take a look at that and see what you think of that treatment. And again, I think it sets you up for, if you really believe in the probability of the company existing and thriving in the future, there's got to be some wonderful opportunities, much like we saw, well, I guess what is now 11 years ago now. So just leave you with that thought. Just 2 slides for you before we go. I'm going to sign off a little bit early today because I'm in the next round of the tennis tournament. That is Burt Lake. We used this slide on for the cancellation conference back in May. That is literally where I'm sitting here right now. And in fact, here's what it looks like today. So I would just like to leave you all with that picture in that suite. And
Great cheer, great tune.
You may all commence envy.
Yeah.
So what's floating right in the middle, Mark?
That's a buoy.
A buoy. Okay.
I don't think it's a grandchild. I hope not. So anyhow, if we have any comments or questions, we can maybe table them or whatever you want to do, Ken. But
yeah, we're just getting kind of general kind of things going on, Mark, and nothing that won't save until next time. A little bit of discussion maybe around stores like Five Below, where the store base closed completely, and yet the sales number for the analysts remained very robust, while the others kind of were pulled back, quite a bit. So a place to start the discussion maybe next month.
Okay, we will.
Or next week, I mean, yeah.
We'll begin cranking on that. And again, you're all invited to submit topics. I did receive another question about Apple. How come if I've done so well, I've made hundreds of dollars per share, why is my par only 3%? We'll talk about that again and just reinforce the difference between a projected return and a return that makes you smile because of what's actually happened. So we'll actually rekindle that. But any subject you want us to kick around, please feel free to send us. Nick DeVergio sent us a couple of comments that we'll dig into a little bit deeper. But you're invited to take us into those areas that we really need to explore a little bit better, and we'll get some neat stuff going on. So with that, I think I will sign off and go attempt to see if I can avoid the consolation bracket in the family tennis tournament.
Well, good
Excellent.
afternoon, Mark. Good afternoon, Hugh, and good afternoon, everybody. Have a great evening this evening.
Thanks, everybody. We'll see you soon.
See
Bye-bye.
you. Thanks, everyone.